Hello, it's time for another homework tutorial. This time we're going to be working on capital budgeting methods, payback, net present value, internal rate of return. Let's jump into the Excel file. Okay, so first off, we're working with the concept of payback. And we're on problem 10.3 out of the book, page 254. Three separate projects each have an initial cash outlay of $10,000. Cash flow for Peter's project is $4,000 per year for 3 years. The cash flow for Paul's project is $2,000 in years 1 and 3 and $8,000 in year 2. Mary's project has a cash flow of $10,000 in year 1, followed by $1,000 each for 2 and 3. So I have created a template for us to work this and entered the details of the cash flows for each product, Peter, Paul, and Mary.
The answer, my friend, is blowing in the wind. The answer is blowing in the wind.
And the book wants us to use the payback method to calculate how many years it will take for each project to recoup the initial investment. That's part A, so that's what we're doing here. Okay, so before we do this, actually I added something that the book doesn't have, but I think it's worthwhile to just calculate the total income for each project. So I'm going to take the sum of not all the cash flows, just the inflows, and we see that it earns $12,000, it spends $10,000. You know, we could just take the sum of the entire project and call this the net income. Let's do that. Auto sum that, and auto sum that. So they all have the same net income. They were structured that way on purpose. So in that case, which one is best? Well, per the payback method, it's going to be the one that pays back the quickest. So these problems are simple enough that we really don't need to set up an Excel algorithm, although we could. Basically, all we need to do is see at what point it pays back. So in year 1, 4 out of the 10,000. Year 2, we've accumulated 8 of the 10,000. You know, if we wanted to do this with math, if it was more complicated, we'd just do a running total equals sum from year 1. So I'm going to lock that in as $6 to itself. So C6 to C6, but notice that first one's locked, so when I expand down, or when I fill down, it now goes from C6 to C7, and then it goes from C6 to C8. Expand that so we can see it. So this is going to pay back somewhere between years 2 and 3, and exactly halfway through year 2. So I can label that as 2.5. I can just see that in my head mathematically that we get an extra 4,000 in year 2. We need 2,000, so it's a halfway point from year 2 to 3. And we could do the same thing if we just copy and paste for Paul and Mary's projects, and we can see that her payback period is year 1. Paul's payback period is year 2. So 2.5, 2, and 1 year. So which project is the most liquid? Well, it would be the one with the shortest payback period, and that's quite easy to see. That's Mary. Okay, so payback is pretty darn simple, and I will allow you to undertake problem 10.7 all by yourself. Notice you just have to put the cash flows in. Year 0 is right now, the money we're going to spend right now. That's typically going to be an outflow, so negative, and then the inflows in years 1 through 4 for the two competing projects. Compare the payback periods, decide on the project choice. Okay, so moving along now and getting into the more sophisticated and really better methods, which are net present value and internal rate of return. Problem 10.9, it says the Bedford Falls Bridge Building Company is considering the purchase of a new crane. George Bailey, the new manager, has had some past management experience while he was the chief financial officer of the local savings and loan. The cost of the crane is $17,291.42. That's going to be our outflow, minus $17,291.42. And the expected incremental cash flows are $5,000 at the end of year 1, $8,000 at the end of year 2, $10,000 at the end of year 3. So let's start off again by just seeing what the net income of the project is. And it does have a positive net income, so that's good. But does it have a positive present value? We'll have to check that against our threshold rate. And it says calculate the net present value if the required rate of return is 9%. I haven't done this yet, so I'm just guessing, but I'm skeptical that this project is going to actually return 9% in 3 years with a net income of only $5,700. But we will see. That's why we need to do the math. Okay, so now let's calculate the net present value. The net present value, you'll remember, is the present value of just the inflows. Whoops, I got to add the net present value, you'll remember, equals NPV. And we start with the rate, which we indicated right there in C13. And then it's the values of the inflows only. So we'll run it C8 through C10. And then we're going to tack on the outflow, which will add because it's a negative number. It's the same as subtracting it. So we'll see that it has a net present value of 1751. So actually a little bit more impressive than I thought. That means the internal rate of return is going to beat 9%. Okay, so we can run the internal rate of return function, IRR equals IRR. And here's just all the values, the outflow and the inflows. And then guess, and I'll just use 9% for my starting point. I know it's going to be higher than that. And indeed, it works out to 14%. So internal rate of return beats the target rate, the threshold rate. It's got a positive net present value. So this project is a go. Problem 1011 is a very similar project. It involves a lettuce farm. It's got two possible irrigation projects that they want to think about. So you're going to enter the cash flows. Remember, the initial one's an outflow, then the inflows for 7 years. Just for fun, calculate the net income of each project just to see if it's positive before we do anything else. And then plug in your rate, run your net present value on your inflows, and then subtract the outflow from that value, run the internal rate of return on all of the values, and then make a decision for each project. And then the book says a comment on whether there's a difference between these two projects between the NPV and the IRR analysis. So I'll let you handle that one on your own. And then just another practice problem on that, 1016, similar kind of problem where you've got a person who's interested in acquiring some mineral rights, doing some oil exploration, and she'll have a negative outflow to purchase the oil, the exploration rights, and then inflows from the project. Actually, inflows for 4 years and then an outflow because there's reclamation costs at the end. We'll do the same thing, find the net income, insert the required rate of return, run NPV, IRR, and then decide whether the project is a winner or not based on the criteria. Is NPV positive? Does the internal rate of return beat the discount threshold rate of choice? Okay, so those ones should be pretty, you should be able to handle those on your own. So let's wrap up then with 1027, which is a little bit more comprehensive application once again of net present value, internal rate of return. So we've got two projects here, and what I'm going to do is walk us through completing one of them. There's a lot of iterations that the question wants us to run. It looks intimidating, but it's not going to be too difficult because Excel's going to help us so quickly do the calculation. So hardest part of this is probably going to be to set it up. I've already created the template, so that's half the battle. So what we have here says Aluminum Building Products Company, ABPC, is considering investing in either of the two mutually exclusive projects described as follows. Project 1, buying a new set of roll-forming tools for its existing roll-forming line to introduce a new cladding product. After its introduction, the product will need to be promoted. This means the cash inflows from additional production will start sometime after and will gradually pick up. So we'll have low initial cash flows here, but then they will grow over time here. So not much payoff, and it was probably fail a payback test, wouldn't it? Not much payoff immediately, but growing payoff in the future, although that's going to be discounted more heavily the farther out in the future. So that's an interesting aspect of that project. Then project 2, modifying its existing roll forming line to increase productivity. Cash inflows from additional production will start immediately and will reduce over time as products move through their life cycle. So we'll get some immediate bang for our buck on that, but then it'll taper off. So less discounting, more early return. So it's going to be interesting to see which project wins out in the analysis. So let's go ahead and plug these values in for project 1, 200,000 outlay to acquire it, and then no payoff, so 0, 0 until year 3, where it's 20,000, and then it grows to 30,000 in year 4, 40 in year 5, 60 in year 6. Evidently, it's increasing growth rate, so they think they're going to get some market penetration here. And then 100,000 in year 7. So what's our total income from the project? Let's just auto sum that. It is positive, so that's a good starting point, but that doesn't guarantee that it has a net present value. That depends on our discount rate. So the initial discount rate This says both of these projects have the same economic life of 8 years and average risk characteristics. ABPC's weighted average cost of capital or hurdle rate or discount rate. There's about half dozen different terms we can use for this: threshold rate, hurdle rate, discount rate, required rate of return. All mean the same thing, and that always enters into the rate component of our calculations here. So there's our rate. Now, it says Part A, which project would you recommend Mrs. Brown accept to maximize the value of the firm? Hence, calculate and compare NPVs. I'll do it for project 1. You can do the same procedure for project 2. Equals NPV of this rate and these inflows, and then subtract the initial outflow. I'm adding it because it's already a negative number. And let me expand my column so we can read that. Oh, it's got a negative NPV. And I'm not too surprised because the bulk of the income occurs out into the future where we are discounting it heavily, and it's not generating a 7% rate of return. So on the NPV decision, I'm going to say no. It's a no-go. Now, just to see what the IRR is, I'm expecting it to be lower than 7.2 because it doesn't have a positive net present value. So the IRR here equals IRR of that set of values. Now we put all the values in, remember, including the initial negative. And then the guess, I'll start at 5%, 0.05. And there we go, it's only 4%. So that project is a stinker, as we say. It doesn't meet the required return. So the IRR decision is going to agree. It's a big fat no. Now you can do the same thing for part A and B, calculate NPV and IRR. And then it says draw the NPV profiles of both projects. Now remember, the NPV profile is a graph of the NPVs at various discount rates. Well, in order to do that, we have to go ahead and calculate the NPV at these discount rates. So to make this easy, and I've just picked out some rates here, 0 through 20% at 2.5%, 250 basis point intervals. So the way I'm going to do this is name my range for my inflows. And let's call this P1CF for cash flow, P1CF. And I'm going to run NPV for this rate. With cell reference, I can fill this function down and it'll just drag down the rate over here as we fill down. And then the values are P1CF. There's my range of values. And then we're going to subtract. Let's do this. Let's add that cell and let's lock that in, because that's always going to be subtracted for each discount rate. So notice I put the dollar sign in front of the 7 to lock that, so that never moves. So we'll always be subtracting the 200,000. Okay, and hey, look, does that make sense? At 0% discount, at no discount, the net present value is just the net income of the project. Yeah, we're not discounting at all. The discount factor falls to 0 there, so that makes perfect sense. And then as we raise our discount rate, the net present value goes down, and that makes sense again because we're discounting by a larger and larger discount factor. So the higher the discount factor, the lower your net present value gets. And this one's going to cross the 0 threshold between 2.5 and 4%. Well, sure, we know that the rate that makes this net present value 0 is 3.97%. And so that occurs between here, so that all jives. So the only thing we need to do now to graph that is select the net present values, insert up here a 2D line graph. I'll do it with the points plotted. And let's name this Project 1 NPV profile. And I could leave it like that. That would work okay. But I should have here on the horizontal axis, I'm going to click on that and select data. And I'm going to edit the series. Whoops, I'm actually going to I'm going to edit my horizontal axis labels to be the percents used for the discount rates here. And there we go. Now those show up as the proper percentages. And we could probably format this a little bit nicer by adding some grid lines to the vertical. There we go. I like that. Okay, so we could clean up the formatting here a little bit. In fact, I'm just going to rearrange that a little bit. I like my values for my horizontal labels to be on the lines, not between them. But that's just me. All right, so there's our net present value profile for project one, and then you can follow the same procedure. You might need to back this video up and watch that again a couple times if you're not familiar with making graphs in Excel. It's very user-friendly though. You'll get the hang of it. You can do that for project two, and then the final component of this question is to, part C says, what is the approximate discount rate at which both projects would have the same NPV? What is that NPV? You can take a stab at that and see if you can figure that out by looking at the graphs. One final thing it asks us in part D is, does the selection remain unaffected for 3 different weighted average costs of capital? Now, what that means is 3 different rate scenarios. So, and we'll label these 1 through 3. And the rates given are 5.4%. Whoops, I meant 5.4. 8.81 and 14.39. All right, well, what do we want to do? We want to run the NPV and IRR again for each scenario. So the rate is this one we just plugged in. My values are my project one cash flow range again. And then we're going to add C7, which was the initial outflow, to net it out. All right, so that makes sense. Anything above 3.97%, this thing's going to have a negative cash flow. And let's run the IRR as well. The values are, it's not project one cash flows, it's all of this. So I could name that range if I wanted to. Let's do that. Let's name the whole range, including the initial outlay, and let's call that project one P1 all. And then I can use that in my IRR function just to make things a little more efficient down here. So now I can do this equals IRR. Values is P1 all. And my guess is, I don't think I need one. There we go, 4%. Now to run that for the other scenarios, and I've mentioned this many times, this is what I love about Excel. All we have to do is copy, because I've set this up properly. And whoops, I want to copy just the NPV IRR component and paste that here. My cell reference will shift down. My NPV keeps rising at a higher discount rate. My IRR stays the same. Okay, copy it, paste it again here, and we see at 14.39% the NPV is even more negative, and the IRR is always going to be the same. All right, and then part E, we're basically doing one more iteration of this, one more repetition. Further market survey research indicates that both projects have lower than average risk, and hence the risk-adjusted discount rate should be 5%. What happens to the rankings of the projects using NPV and IRR as the selection criteria? Explain the conflict in ranking, if any. So I basically want to do this whole procedure again. I'm going to paste all of them in here, but now I'm going to change my rate to 5. And I don't know what it is for the other one, but you can run that and then see if there's any difference between NPV and IRR ranking versus the two projects. This one is going to be a no-go on the base of both NPV and IRR. This one, my sense is that it might depend on what discount rate we choose, so we're going to have to run all those options and then see what we get.